If every nation on Earth is drowning in debt, if governments owe more money than they can ever realistically repay, if global debt keeps rising faster than economies grow, then who exactly is everyone indebted to? Because here's the twist. There is no single villain hiding behind a curtain. There is no one mastermind counting repayments in a gold-plated vault. The truth is stranger, broader, and far more unsettling. Our financial world is built on a debt web, an interconnected, self-reinforcing system designed so that no country can ever truly exit it. A system where nations owe money to each other, to their own banks, to foreign institutions, and to invisible financial markets that can punish or reward them at will. And yet, despite decades of reforms, global summits, new laws, tighter regulations, digital currencies, and political promises, the debt never shrinks, it only grows. Why? Because the system wasn't built to be solved, it was built to be permanent. Today, we're going to unravel this global debt web, where it came from, who engineered it, how it traps every nation, why no one is allowed to leave it, and where this quietly engineered dependency is dragging the future of the world economy. This is the story of the global debt web, designed to keep every nation permanently dependent. Before we answer the big mystery, we need to understand how the modern financial world came to exist. Not the history we learned in school, the real story. Because at the heart of our global economy is something deceptively simple. Debt is not a side effect of the system. Debt is the system. But it wasn't always this way. The post-war blueprint in 1944, as World War II neared its end, world leaders gathered in a quiet hotel in Bretton Woods, New Hampshire. Their mission: create a new financial order to prevent future economic collapses and wars. Their solution: a global monetary structure built around the US dollar, which at the time was backed by gold. Nations signed on. The US became the anchor. Trade became more predictable. Rebuilding became possible. And yet, hidden inside this agreement was an unintended consequence. To participate in the new system, nations had to borrow. Reconstruction loans, development loans, infrastructure loans, currency stabilization loans. Debt became the entry ticket, and the world signed up. Key players emerge out of the Bretton Woods order came institutions that still shape the world today. The International Monetary Fund, IMF, the World Bank, a global network of central banks. Their role: officially stabilize the world economy. Unofficially, create a system where money is borrowed into existence. But to keep nations participating, something else had to evolve. A hidden mechanism that guaranteed governments would always need more money than they had. That mechanism was about to take shape. The debt web truly begins in 1971, one of the most important, least understood economic events in history. The Nixon shock. President Richard Nixon ended the convertibility of dollars into gold. This single announcement instantly detached global currencies from anything of physical value. Money became abstract, a promise, a claim, a liability on someone else's balance sheet. In other words, money became debt. From that point forward, governments issued debt to fund spending. Banks issued credit that instantly became new money. Investors bought and sold debt as their primary asset. Central banks manipulated interest rates to control debt flow. This wasn't a flaw, this was the new design. A design that required one thing: constant expansion. Because in a system where money is created through borrowing, the moment the world stops going deeper into debt, the system collapses. And so a feedback loop began. Governments borrowed more to grow. Banks issued more credit to profit. Corporations borrowed to expand. People borrowed to survive rising costs. And central banks kept interest rates low to fuel the cycle. Eventually, debt became the lifeblood of global growth. By the 1980s and 1990s, borrowing had become the default strategy for nations around the world. But something else was happening, something more subtle and far more powerful. Financial markets took control. Once money became debt, financial markets turned government borrowing into the world's most important product: sovereign bonds. These weren't just loans. They became the backbone of pensions, insurance funds, corporate reserves, international trade, and the global banking system. Investors demanded more bonds. Governments obliged by issuing more debt. Banks packaged and resold this debt for profit. Investors leveraged it to borrow even more. A global web formed. Countries owed money to global markets. Markets depended on countries keeping debt high. Banks depended on bond sales. Governments depended on banks to buy their debt. Everyone became trapped in everyone else's balance sheet. Enter the credit rating agencies. As the debt web expanded, 3 private companies gained unprecedented power: Moody's, S&P, Fitch. Their ratings could collapse a nation's currency, raise its borrowing costs, trigger capital flight, or push it toward emergency IMF loans. A downgrade wasn't just a warning, it was a punishment. Suddenly, governments were no longer fully sovereign. Their survival depended on satisfying the expectations of global lenders, and the web tightened. By the early 2000s, global debt had exploded, but the true breaking point came during the 2008 financial crisis. The world learned a painful truth. If debt stops growing, everything breaks. Banks froze, credit stopped flowing, governments panicked, central banks intervened on a scale never seen before. Their solution to a debt crisis: more debt, much more, trillions of dollars created overnight, interest rates slashed to zero, bailouts, quantitative easing, bond buying programs. The message was clear: without constant debt expansion, the global economy doesn't grow, it collapses. This was the moment nations realized they were no longer steering the ship, they were passengers on an unstoppable vessel. After 2008, the world didn't fix its debt addiction, it doubled down. Global debt now exceeds $300 trillion, more than 3 times global GDP, and it continues rising. But here's where the web becomes dangerous. 1. Nations can't default without global consequences. If a major country defaults, banks around the world face losses, pension funds collapse, governments lose reserves, financial markets panic. Default becomes a nuclear option. Everyone avoids it. Everyone chooses more debt instead. 2. Debt servicing replaces social spending in many countries. Interest payments exceed education or healthcare budgets. Nations no longer borrow for growth, they borrow to pay interest on previous borrowing. 3. Bond markets command policy. If investors dislike a government policy, they dump its bonds. Borrowing costs spike, currency weakens. Political pressure mounts. This is why policy often looks the same across countries. Governments don't choose freely, they choose what keeps the markets calm. 4. Central banks are stuck if interest rates rise. Governments can't afford payments. Banks collapse, markets tank if rates stay low. Debt grows, bubbles, inflate, currencies weaken. There is no good choice. Only delay the inevitable. 5. The dependency is now structural. Nations no longer control their financial destiny. Markets do. Creditors do. Central banks do. Debt flows do. The web has become permanent. Over the last 50 years, world leaders have attempted countless solutions. Austerity, tax hikes, spending cuts, debt restructuring, currency devaluations, IMF bailout packages, new fiscal rules, central bank independence. None worked. Why? Because every fix requires borrowing more before you borrow less. Austerity, economy slows, gives tax revenue falls, gives more borrowing. Bailouts, governments rescue banks, gives issue more debt. Low interest rates, encourage even more borrowing. New regulations, require governments to fund compliance and restructuring. Each attempt only reinforces the dependency. It's like trying to cure an addiction with a higher dose. Today, we're watching the exact same pattern unfold across continents. The United States, over $34 trillion in national debt, borrowing more than $1 trillion every 100 days. Federal interest payments higher than defense spending. The world's safe asset is now the world's biggest debtor. Europe, Italy's debt above 140% of GDP. France and the UK drowning in deficits. Germany facing recession but forced to borrow to stabilize. Europe, China, massive local government debt, property collapse, hidden municipal financing vehicles with trillions in liabilities. Developing nations, more than 50 countries, are at high risk of default. Yet the only way to avoid default is borrowing more. The pattern never changes because the design never changed. The global debt web forces nations into the same loop again and again. And history shows us one thing: when a system grows too interconnected, too leveraged, too fragile, it doesn't unwind, it snaps. But no one knows when or what comes after. Takeaway number 1. The debt web wasn't an accident. It evolved from decades of policy choices that made borrowing the engine of global growth. Debt is now built into the architecture of the world economy. Takeaway number 2. No nation is immune. From the US to emerging markets, every country depends on continuous borrowing to avoid collapse. Sovereignty now has an interest rate attached to it. Takeaway number 3. The system cannot fix itself. Every proposed solution requires more debt, not less. The web reinforces itself, feeding expansion and punishing withdrawal. The warning: when every part of a system depends on everything else, not failing. The real danger isn't a single country defaulting. The danger is what happens when the web finally reaches a point where no one can take on more debt. At some point, growth can't keep up, interest can't be paid, borrowing can't expand fast enough. When that day comes, the world may face a financial reset unlike anything in modern history. If you found this breakdown eye-opening, if you want deeper dives into money history, global finance, and hidden economic mechanisms, make sure to like, subscribe, and share this video with someone who still believes countries can simply pay off their debt. Because once you understand the global debt web, you understand why that will never happen and why our future will depend on what replaces this system.